All right, everyone. Welcome to this week's edition of Wealth Wednesday. We're going to be talking about the 7 steps that you need to take to create a tax-efficient income stream in retirement. So let me know right off the bat if you guys can hear me. Again, we're using a little bit different type of streaming software. So let me know if you can hear me. I'm just going to log in quick so I can see if anybody comments and share my screen, and we'll get going. Now this presentation is probably going to run a little bit longer than a half hour. I feel like mine usually do. I like to drone on a little bit, but hopefully you guys are getting some valuable content from this. So, all right, talking about 7 ways to create, or 7 steps to creating a tax efficient income and lowering your largest expense through just better planning. No tricks. No pulling a rabbit out of a hat or anything, but just through better planning and better estimation of your future tax situation. So if you've ever been to a seminar or an event, or even if you've ever read the legal disclosures on your advisor's marketing material or the plan that they build, they'll often include this disclaimer, and it says, again, pick whatever firm name. ABC Financial and its affiliates do not provide tax, legal, or accounting advice. This material has been prepared for informational purposes only, blah, blah, blah. And they basically tell you to consult your accountant, your CPA, with any tax questions that you have. And everybody includes this disclaimer on their material. But do you know by law, a financial advisor has to provide you with tax advice? And this makes sense, right? If you withdraw money from your account, they have to know what the tax effect will be. Okay, the last thing you want to be doing is moving an account from one place to another, and all of a sudden you have a multi-$100,000 tax burden. So a financial advisor by law actually has to provide you with tax advice. So you might see this disclaimer all over the place. One place you will not see it is with Safeguard Wealth Management. We provide tax advice. We understand the tax code, and by law, financial advisors have to. Okay, they have to let you know the tax implications. So I don't even think this type of disclaimer should be legal, but we see it all over the place. And we know as you move through retirement, as you move through retirement, taxes are going to be your largest expense. And so just right off the bat, let's set the stage for why this is so important. Okay, on the screen right now, we have a chart going back to the early 1900s. Okay, and it shows the highest tax rate and the lowest tax rate in over the last 100+ years. Okay, and as we can see, these tax rates have ebbed and flowed throughout time. Okay, usually when debt has gotten very high in the country, tax rates have gone up afterwards. So we see that after the world war is over here, essentially, we see tax rates going very high. Okay, at one point, the highest tax rate ever was 94%, meaning somebody taking $100 only got to keep 4 of those dollars, or 6 of those dollars. They had to pay out 94 of those to the government. Okay, so if you'll notice, just over to the right side here, and it looks like this probably only goes to somewhere in the 2010s. Okay, but we see that we're in some of the lowest tax brackets that we've ever seen. Okay, whether you look at the lowest or the highest. And so, funny enough, and really it's not that funny, but the government has been adding more and more debt as of late. And so in the past, as the government's added more debt, taxes have gone up. Well, right now we're at a little bit of a tug of war where taxes are extremely low, but debt is growing. Okay, and latest graph shows that we're at debt levels, debt to GDP. So GDP is essentially, if you look at all the services and the goods that America creates, and you put a dollar value on that each year, that's GDP. Okay, so it's basically like the country's income, if you will, income generation. And so we see right now we're at debt levels that are as high and will exceed those of World War II. And again, taxes went up significantly after World War II. I'm not going to make a prediction here that taxes are going to rise to those post-World War II levels, I just want to get across to you guys that something has to give at some point in the future. Okay, looks like we're adding another stimulus bill, so this is going to go even higher, but something has to give. Either the government needs to spend less money or taxes are going to go up. And maybe it might even be a combination of both. I don't see too many people talking about spending less money right now. So something's got to give as we go forward in the future. We've already kind of alluded to it. Your largest retirement expense will be taxes. Okay. Hopefully I can move this. Hopefully you guys see this moved out of the way now. So let's get into the meat and potatoes though. We know taxes are going to be important in the future. Every dollar you save is a dollar that you get to keep as income, or a dollar that gets to stay in your retirement and keep growing for the future. So how can we save on taxes? Well, the very first step, and it's the simplest of steps, but it is critical to find your exact income target. Okay. And this is what I say is the tail that wags the tax dog, if you will. Okay. Because when we're developing a tax plan for somebody, the income target is the number that is going to drive everything. Okay. And it makes sense, right? Knowing how much income you need to take, we know what tax brackets we're going to be in. Obviously, if we need $50,000, if you're married and you need $50,000 of income, your tax situation is going to look different than if you need $75,000 of income. Okay. So right off the bat, we need to start by zeroing in on this income target and getting very clear on this. Okay. A plan is only as good as the accuracy of this number. Okay. If we are shooting a bow and arrow, okay, and we don't know what target we're shooting at, and we're just blindly pulling it back and shooting it, we're likely not going to hit that target. So we need to know exactly where this target is and have it laid out in our minds. And just know this number will invariably change through retirement. Okay. First off, just because of life-changing events. Okay. So let's say you retire at 62. Okay. Let's say you're delaying Social Security to your full retirement age. Okay. Well, you also might, again, retiring at 62, you might be on Obamacare insurance. Okay. Or you might have a continuance from work. Okay. Well, from 60 to 65, or 62 to 65, your healthcare costs are likely going to be a little bit more unless you're getting a subsidy from Obamacare. Okay. When you turn 65, your healthcare costs are going to drop a little bit because Medicare is typically a little bit more preferred for insurance purposes or for healthcare purposes. If you're delaying Social Security, you have to pull that money from somewhere else, typically IRAs. Well, those IRAs will carry a different tax liability than when you're on Social Security. Okay. And so these life-changing events and what your retirement plan is going to look like, that number will change through time. If you're planning on traveling for the first decade or 2 decades in retirement, and then not traveling as much after, obviously that will change it. And that would be an example of on purpose, you're changing that income target through time. Okay. So you need to be clear on this income target. And how can you find it? Well, first, starting at the basics. What do you need to stay retired? What do you absolutely need no matter what? If you can't afford these, you have to go back and work. What are your needs in retirement? Things like groceries, housing, healthcare, okay, utilities. Those are things that we can't fund those. You have to go back to work or figure out another form of being able to pay for those. So those are obviously our very basic needs. Okay. Layout doesn't have to be a super in-depth spreadsheet, but just kind of jot down how much you're spending on those each and every month. Okay. That's basically the first thing we need to figure out. From there, we don't want to just retire and sit in front of the TV for the rest of our lives. So we likely want to go and enjoy hobbies that we've put off. Okay. Things like traveling. Okay. Hunting and fishing, going on trips. Okay. Maybe buying a cottage and spending more time up north, snowbirding down. When it gets cold up here, going down to the south and spending some time down there. Okay. So what do you want? What hobbies are you wanting to do in retirement, and what are the costs of those? Those are added on that. Okay. So our needs for a given year might be $4,000 net of taxes. Okay. Our wants might be another $2,000 a month. Okay. And so we get to $6,000 a month net of taxes. Okay. And make sure we're including healthcare costs on here. We'll show an example in a sec what happens if you don't accurately include healthcare costs. And then wishes. And some people might not have any long-term wishes. Some people might have some continual ones. And these are typically less important, but it'd be, ideally, I'd like to buy a new vehicle every couple of years, or I'd like to give this much to charity, or I'd like to give this much to our heirs. Okay. And obviously those will be down the line, but we have to factor it into your plan. Okay. So let's just go through a quick situation. And this is a income chart. You'll see a bunch of bars here. Basically, this is this orange line here is their income needs through time. And each of these bars below are how they fill that income need. So they have a pension in here. This dark blue is Social Security, and then this light blue is portfolio withdrawals. This green is RMDs. Okay, so this is somebody who starts retirement needing $75,000 of income. Now, notice this line goes up through time. Why is that? Well, inflation. Okay, you need income raises in retirement just to keep up with your normal standard of living. These bumps in here, every 2 years they want to go on vacation. Okay, so big vacation every other year. And so that's also factored in. And so after, if we just upload their situation with all of their assets, notice at the end of their life, they have $282,000 left. So they have a little bit of a buffer living out to into their 90s. And this gives them an 88% probability of success. For those that don't exactly know how we plan for retirement, we run every situation under 1,000 simulations, if you will. Okay. So in one of those, of those 1,000 simulations, variables are changed a little bit in each situation. So in one, those 1,000 situations, market returns are varied. Okay. And so they had 880 of those simulations that were successful. Okay. Needing $75,000 of income. So what happens if they were just a little bit off? Okay. What happens if they didn't accurately calculate taxes right? They didn't accurately include healthcare costs. And so they retired and found out that they actually need $80,000 of annual income. Okay. So they need $5,000 more a year because going into retirement, they got one variable wrong. Well, notice what happens to their probability of success and the money that's left over. Okay. $282,000 turns target, because a shift one way or another slightly can have a huge impact. Okay. If you're off on healthcare costs, if you don't have taxes calculated exactly right, it can be a huge issue. Okay. Especially over the long term. Okay. And if you don't calculate one of these expenses right, what's the first thing to give in your retirement? It's the hobbies. Okay. You're not going to forego your needs. You're not going to forego groceries. Okay. You're going to forego those hobbies. And that's kind of the reason you retired in the first place anyway. So step number 2, estimating your longevity. So how long does our retirement savings need to last? And obviously no one knows the question to this. It's what makes retirement planning so hard. Okay. How long do we need to plan for? Now you can go off basic life expectancy tables. Social Security Administration releases one. I think there are a few better calculators that zero in a little bit more on your situation, more personalized. Okay. A couple of them that you can Google: Living to 100, Blue Zone's Vitality Compass, the Big Life life expectancy calculator. Each one of these will ask anywhere from couple dozen questions to as many as 100 questions. Okay. And they'll really zero in on, have you ever smoked? Do you have any of these underlying conditions? And after you're finished, they'll give you a decent estimation. Now, obviously that estimation, we can't put that in stone. A lot of things can happen between now and over those years till you get to that point. But having an estimation for how long you might live is important. Okay, it lets us plan a little bit better. And just kind of speaking on basic life expectancy tables, if you're a 65-year-old male right now, you have a 50% chance of living to 87, a 1 in 4 of living to 92. Okay, if you're a female, it's 89 and 94. They tend to live a little bit longer. And if you're married, you have a 50% chance of living to 92, 1 in 4 of living to 98. Okay, so retirements statistically have been moving ahead sooner, so people are retiring earlier. Well, the baby boomer generation is set to live longer than any generation before them. Okay, and they don't have pensions, and our pensions aren't as widely distributed. Okay, so if you're retiring at 62 and you potentially might live to 92, that's a 30-year retirement. Your money needs to last that long. And so estimating this retirement income over the next 30 years is an important variable. Okay, knowing how taxes are going to change as we go forward in the future. So these are the first two basic things that you need to be clear on. What does your longevity look like based on your health history? And we host a ton of educational classes on Social Security, and we kind of developed this framework for how to maximize your Social Security benefit. Okay, now the first step is when to file, and this is where most people stop. They look tax effect. Okay, it doesn't matter how big our Social Security benefit is. It matters how much of that benefit we actually keep after taxes. And we have to look at everything in our retirement through this tax lens. It's about what you keep, not about what you make. Okay. And so Social Security's how much of your benefit ends up becoming taxable for Social Security is based on this formula right here, provisional income. Okay. And to find provisional income, you take your adjusted gross income. So income from things like pensions, annuities, IRA withdrawals, okay, W-2 income, okay, all of these are included in your adjusted gross income. Capital gains, you take tax exempt income, which would be things like muni bond interest, and then half of your Social Security benefit, okay, and then it gets plugged into this table to figure out Social Security taxability. I'm not going to walk through an example just for the sake of time here. What I want to zero in on is for how they figure out your Social Security, how much of your benefit is taxed. Notice that everything in this equation is included dollar for dollar, except for your Social Security benefit. Okay, that's included 50 cents for every dollar of benefit that you have. So if you want to keep your provisional income number low and therefore keep your taxability lower, okay, the more you have coming from Social Security, the lower this provisional income is going to be. Okay, so let's walk through an example. Let's say that you need $95,000 of income this year. Okay, and so let's say you don't have any Social Security benefit. Okay, which means all of that money needs to come from your IRAs, which means all of that money is taxable. Okay, so if you had to pull it all from your IRAs, you would owe just under $8,000 in taxes. Okay. Now, let's say you took your Social Security benefit at 62. Now, if you take your benefit at 62, you are taking it early. Okay. You receive a permanent penalty for taking your benefit early. Okay. In this case, this is a married couple, by the way, and we're just looking at federal income taxes. Okay. So they have $37,000 coming from Social Security and $58,000 that they're pulling from their IRAs in order to reach this $95,000 number. Okay. And notice taxes improve a little bit by having income come from Social Security. Social Security is a tax preference asset, but we really only save about $600 here. Okay. But notice what happens when they maximize their benefit. They take a suggested strategy. This strategy involves delaying their benefit. Okay, because they delay, they get a step up in benefits. They get a higher benefit. Okay, in this case, they get $65,000 from Social Security, which means they only need to pull $30,000 from their IRAs or their 401ks or pension income. Okay, and notice what happens to taxes over here. Okay, because they're taking more of their income from Social Security, their taxes drop significantly. Okay, by over $5,000 in this scenario. Okay, so if you want to create a tax efficient income, Social Security is the foundation. Okay, it's one of your most unique assets. It's next to a Roth IRA. I think it's your most tax preference asset. And so the more that you can get from Social Security, the more tax savings you are going to have throughout retirement. And that's why it's so important to make sure that you get your Social Security strategy right. Okay, step number 4. Okay, so we've covered figuring out your income, knowing your longevity, and then maximizing the foundational asset that Social Security is. Step number 4, something called asset location. So you'll probably hear asset allocation talked about all the time. Asset allocation is how much should you have in each asset class? Should you put 60% of your money in stocks or 50% of your money in stocks? And the financial media will drone on about that all day. What's more important is asset location. In what tax bucket are your assets located? Okay. And so 3 types of money in general, 3 different types of tax buckets. You have a taxable account. This would be things like a brokerage account, a joint account, a community property account. And if you're not careful, you can be taxed on that money each and every year. Okay, that's why it's often considered the leakiest bucket. Then you have tax deferred accounts, things like IRAs, 401ks. That's money that when you pull it out, you are taxed at regular income rates. So notice it's only got 1 leak in it. And then finally, you have your tax-free bucket. So this would be things like Roth IRAs. And so, but in your retirement, what does your bucket look like? How much do you have in each of these accounts? Oftentimes we see the majority of people have the most money in this tax-deferred account. Very little money over here in the tax-free account and very little over in this taxable account. Well, interestingly enough, how we plan for retirement, this is how we rank the buckets. Okay, we've talked about this before in past Wealth Wednesdays. We can certainly tag you if you are interested in learning more about how to patch up these holes in a taxable bucket. But if you patch up those holes in the taxable bucket, I think a taxable account is your second most important account. The reason being is because of how it's taxed. We'll cover that in a second. Your tax deferred account, regardless of when you pull the money out, how much you pull out, you are taxed at normal income rates. Okay, taxed at the highest rates that you can be taxed at. Okay, so we view this as your worst bucket. Now, granted, that doesn't mean you should try to get all of your money out of that bucket. That doesn't mean that while you're working, you shouldn't contribute to that bucket. That just means this bucket becomes a liability as you move through retirement. Your tax-free bucket is the best bucket. It's the never taxed again money. That money could grow to $100 million, okay, theoretically, and you could pull it all out tax-free, okay? So how are each of these buckets taxed? Okay, let's go through the Roth tax bracket first. And notice there isn't a typo on the screen. There is no graph. Again, the reason being is because Roth money will not be taxed again. Once you have money in your Roth bucket, that is tax-free money you can pull out, okay? Here are the taxable account rates. And this is why I say that your taxable account, if managed properly, is your second most important account. Okay, you get a preferential rate on long-term capital gains. The government gives you a benefit for investing in companies for the long term. And so notice, I believe these are 2020 rates, but for a married couple, the first $80,000 of capital gains, if you have a taxable income less than $80,000, you owe 0% on money withdrawn from taxable accounts. And the next range is 15%. Then once you make over $250,000 as a married couple, there's a 3.8% Obamacare surtax. And so we see 15% goes to 18.3 and 23.8. Okay. But if we just layer over the tax deferred accounts, things like IRAs and 401ks, we see that across the board, regardless of where your taxable income is at, you will pay more withdrawing from tax deferred accounts than you will withdrawing from taxable accounts. Notice, let's just look at $100,000. Okay. At $100,000 worth of income, you're taxed at 22% versus 15%. So there is a tax savings regardless of how much you make if you're taking from taxable accounts and subject to long-term capital gains. And then obviously, tax deferred account here, we can see it gets as high as 37%, but will go up depending on how much income you have. So the more income you pull from IRAs, the more tax you're going to owe. Okay. So let's wrap around to this asset location and talk about, okay, we've talked about where your assets are located in which buckets and which buckets are best to have assets. But now let's think about, as we're investing, how can we invest in the right way to make sure we have the most money in the right buckets? Okay. So let's go through a quick scenario. Let's say that someone has $500,000 to invest. They have half of that. So $250,000 in their traditional IRA, and they have $250,000 in their Roth IRA. Okay. And they're going to invest 50% into stocks, 50% into bonds. Now, we work with retirees every day. I build a lot of plans, and the majority of the time, when I see how other financial advisors invest their clients' money, if they have 50% stocks, 50% bonds, and they have a 50-50 split of assets, they'll put half the stocks in the traditional IRA and half the bonds. They'll put half of the stocks in the Roth IRA and half of the bonds. And intuitively, this makes sense on the front end. After all, you want to be 50-50. Okay, so let's put 50-50 in each account. Well, think about this through a tax lens. Okay, this traditional IRA, when we withdraw money, it's going to be fully taxed. This Roth IRA is money that we've already paid taxes on. It will never be taxed again. So as our money grows, where do we want the most growth to come from? This Roth IRA, right? And so what would make the most sense is that we know stocks over the long term will outgrow bonds. They have in every scenario going back into history, again, over the long term. We know bonds are slower growth. They're supposed to offer more safety. However, that window is closing. Tony's talked about that a lot. But you would want to put all of those bonds in the traditional IRA. We want that IRA to grow slower. Okay. You would put all the stocks in the Roth IRA because we want that Roth IRA to grow as big as possible. Okay. So what impact does this have over time? No performance difference. We're assuming stocks perform the same, bonds perform the same, regardless of if they coordinate in this asset allocation idea or they don't coordinate within it. But if they coordinate this asset allocation idea right and put all of the stock in their Roth, all of the bonds in their traditional IRA, the difference over 30 years is over $345,000. Again, no performance difference. We're just looking at after-tax savings, okay? Because that Roth IRA grows larger, the traditional IRA doesn't. And so after tax-wise, there is significant growth, okay? So question to you, think about your assets. Okay, are you currently investing your assets in a way where you are maximizing the after-tax benefit of those assets? Okay, so that's step number 4. Step number 5 is, once again, something that we've talked quite a bit about, RMD estimation. So how are you planning for taxes in retirement right now? How most people plan for taxes is at the end of the year, they have a shoebox full of receipts. They want to itemize in some way. And so they take that into their CPA. And at the end of the year, they go, here's my situation. What can you save me? Okay. And that might work while you're working. Okay. That might be a sufficient strategy. But once you enter retirement, throw that strategy out the window. Okay. You need to plan for taxes from the moment you retire and have an estimation of what taxes are going to look like through your retirement. Okay. Because there are different hurdles that'll show up in retirement that didn't show up while you were working. Things like Social Security creates a hurdle. Healthcare costs create a hurdle. RMDs, once you turn 72, create a hurdle. So ideally what you want is what we call a forward-looking tax plan, okay, that estimates how tax rates are going to grow through time, how your assets are going to grow through time, and what your income is going to look through as we go through time. Okay, so we can see, hey, okay, if I need $100,000 this year, 15 years from now, I might need $160,000. Okay, well, what are the tax implications when I pull that $160,000 15 years from now? Okay, so we need to have a map of the future tax rates. We need to know your estimated income and assets, and then we need to stress test this. Okay, we don't just build one plan and assume that one forward-looking tax plan is right. We want to look at a few different scenarios. Look at what happens if taxes go up in the future. So we're making a best educated plan for saving on taxes. Okay, so RMD estimation will look different for everyone. Okay, it'll look different depending on your income need, but it'll also look different depending on how much you have in tax deferred assets. And just to note, tax deferred assets, things like IRAs, 401ks, are the only thing that are subject to RMDs. Roth IRAs are not subject to RMDs. You're not forced to ever pull money from that as of right now. You're not forced to pull money from taxable accounts. Okay. You're not forced to pull money from HSAs. Okay. Tax deferred accounts are the only thing subject to RMDs. So let's say we have a couple with $70,000 of income need. Okay. Well, couple one has $500,000 in tax deferred assets. Couple two has $750,000, and couple three has 1.2 million. Each of these people will have a different RMD estimation. That's why a forward-looking tax plan has to be specific to your situation. And so let's go through a quick example on how RMDs can really throw you into a tax nightmare. Okay, so let's say we have a situation where prior to RMDs, there's a couple who has a pension. Okay, they're taking from Social Security. So that's this guaranteed income bucket that we're talking about here. And between those two buckets, Social Security and a pension, they have more income than they need. So they're in a great situation. Okay, a very enviable situation by most. Okay, they have $110,000 guaranteed coming from guaranteed safe sources. Their income need is only $101,000. Now, estimated taxes in this situation are $8,720. Okay, this is a situation that this is forward in time. So the estimated taxes, I believe this is later in the 2020s, their situation. But even after taxes, they still have a small surplus. Okay, now the following year, they're going to go they're going to be 72 and subject to RMDs. And because of their asset, their tax deferred asset amount, their RMD is going to be $28,709. Now, this is forward in the future. So the Tax Cuts and Jobs Act has expired. So the 22% bracket turns into the 25% bracket. Okay. And so they're going to owe taxes on that RMD at 25%. Okay. That's going to be $7,177. But then they're subject to something called the Social Security tax torpedo or the Social Security tax trap. Basically what happens, that RMD is going to push more of their Social Security benefit into becoming taxable. So essentially they're double taxed in a way. And we'll go through what that tax trap is in a second. But it's going to cause 85% of this distribution amount of their Social Security benefit will become taxable. Okay, and it'll become taxable again at 25%. So they're double taxed. They're going to owe $6,100 on additional taxes on Social Security, which means the total tax that they're going to owe on this RMD is 46.25%. Okay, 46.25%. All because of this forced distribution. Now, they didn't have an income need prior to RMDs. So why would they take from their IRAs, right? They didn't have the income needs, so they just thought, well, great, we're just going to let those things grow. Well, what happens is they turn 72 and are forced to take money they don't need, and it puts them into a tax nightmare. They only get $15,000 of that $28,000 RMD. And so step number 6 is to know your annual tax brackets. Know how Social Security affects those brackets. Know later on in retirement or where RMDs push you into, that you might be in the 12% bracket. RMDs might push you into the 22. Okay. So again, this is something that we lay out, but it's something all of your advisors should be laying out for you, looking at your tax brackets, looking at how your income looks through time. Okay, so these green bars right here are RMDs. Okay, this is the income this specific couple doesn't need. This blue line down here, this green line, and this purple line are tax brackets through time. Okay, so notice the 22% bracket turns into the 25% bracket. Again, because Tax Cuts and Jobs Act is expiring. The 24 turns into the 28. The 12 turns into the 15 down here. Okay, so prior to turning on Social Security, their income is in the 12% bracket. Or sorry, they're under the 12% bracket. They turn on Social Security, RMDs push them up into the 12% bracket and knocking on the door of this 22% bracket. Okay, so again, we want to know what this looks like. If this was a situation where this couple had significant tax deferred accounts and these RMDs push them well into the 22% bracket, well, we would be wanting to take actions up here at the early part of retirement to minimize these RMDs later, so they stay out of the 22% bracket. Okay, so this is what most retirees think their tax brackets look like in retirement. After all, this is what they looked like while you were working. And so they look at, okay, if I need $70,000 of income and I pull that income from my IRAs, I'm going to, underneath the standard deduction, I'm not going to be taxed at all. Then I'm going to be taxed at 10% and 12%. Okay. Well, when you enter retirement, and especially when you turn on Social Security, you enter a different tax bracket. And so just to start out, the reason that we want to know our annual tax brackets is because it's going to determine which accounts we withdraw from in a given year. Okay, for instance, let's say we're on the doorstep of, we're in the 22% bracket, and if we take $1,000 more, we're going to be in the 24% bracket. Okay, well, if we know we're not going to be in the 24% bracket into the future, we might want to take from Roth accounts in order to avoid being taxed at 24%. Okay, now that doesn't make as big of a, that example I just gave you doesn't make as big of a difference. This example will. So this is what your actual tax brackets look like when you retire and are on Social Security. So the blue line here is the previous workers' tax brackets. The red line here is the retirees' tax brackets. Okay, and this is going to look different for everybody. Okay, you can't just snapshot this and be like, okay, if I take $20,000 worth of income, I'm going to be over here. It's going to look different for everybody based on your Social Security benefit. So how this tax bracket is created is because as you take more money from your IRAs, okay, the amount of Social Security that is taxed will go up. Okay, so taking $1,000 from your IRAs might cause you to also owe extra taxes on your Social Security benefit. In a sense, you're double taxed. Okay, this is called the Social Security tax torpedo or the Social Security tax trap. Okay, so let's go through that same example. Let's say that you're right here. Okay, your income falls right here, and you're deciding, hey, I need an extra couple $1,000s to pay for healthcare, to pay for whatever it is in retirement. Well, the reason you want to know your annual tax brackets is because you do not want to pull from your IRAs if you're right on the doorstep of this 40.7% part of this trap. You might not even want to pull from your IRAs if you're in this zone as well. It depends on what your situation looks like, but it's very clear when we look at 40.7, because remember, that's higher than any other bracket that we're seeing right now. The highest federal income bracket is 37%. So 40.7 is obviously significantly, well, not significantly, but it's higher than that. Okay. And so if we're right on the doorstep we want to know our tax brackets because we want to make sure we're pulling from Roth assets rather than pulling from IRAs and losing 40 cents on the dollar for every dollar we pull. So a little bit of a trivia question. What's the highest federal tax rate a retiree can be subject to in 2021? Now, when we ask this at some of our live events, usually I get an answer like 37%. After all, that's the highest federal income rate. Or someone that was paying attention to this bracket goes 40.7%. Well, as we add more variables into this annual tax bracket, the situation gets more complex. Okay, so before, this is just showing pulling from IRAs and having a Social Security benefit. Now we're going to add in some capital gains from our taxable account. Okay, and remember, if we go way the heck back, it might be too far back. That's not worth it to go this far back. Okay, the first amount, depending on where our taxable income is, when it's less than $80,000, money that we pull from our taxable accounts, if it's long-term capital gains, is taxed at 0%. Well, when you cross over and start making, have a taxable income more than that, that same capital gains rate is, that same distribution from taxable accounts is 15%. Okay, so this graph that I'm showing here, that's a little more complex version of the Social Security tax trap, is created when taking more from your IRAs causes more of your Social Security benefit into becoming taxable, which causes that long-term distribution from your taxable account to being taxed as well. Okay, so let's go through kind of a simple example. Let's say you're in the 12% tax bracket. Okay, so you're somewhere in here and you withdraw $1,000 extra from your retirement for whatever reason. Intuitively, you think, okay, if I'm withdrawing $1,000 in a 12% bracket, I should owe $120 in taxes. Well, what actually happens is you're taxed, you do owe $120 on that $1,000 distribution. Okay, but that $1,000 distribution also causes $850 of your Social Security benefit into becoming taxable as well. Okay, so 12% of $850 is $102. But that extra taxable income, again, $1,000 and then the extra $850 from Social Security, so $1,850 causes those previously 0% capital gains to now be taxed at 15%. Okay, so at 15% on $1,850, you owe $277.50. And so you think you're in the 12% tax bracket. Your actual tax rate is $499.50. So it's 49.95%. That's the highest tax rate that you can be subject to because of this tax trap. Okay, and so again, if we're right on the edge of this, and we won't know that if we take $1,000 extra from our assets, we're going to owe 49%. Okay, we obviously want to take from Roth accounts. We want to take from money that doesn't count as taxable income. This is why it's so important to know those annual tax brackets. Okay, and then number 7, once you've gone through all of these steps, you've maximized Social Security, you found your income target, you know how long you're going to live, you've estimated RMDs, you know your annual tax brackets. Well, now how do you, on top of Social Security, how do you fill in your income accordingly? If you have $60,000 of a Social Security benefit and you need $20,000 more, which accounts should you withdraw from in any given year? Okay, every account you withdraw from will have a different tax implication. Withdrawing from Roth, you won't owe anything. Withdrawing from taxable accounts, will probably owe long-term capital gains. If you withdraw from IRAs, you'll owe income taxes. So this basically different tax implication scenario you'll have to play out this year as well as every year to come. So we need to not only have our estimated taxes this year, but also know what they're going to be in the future. Every year you will face this decision. Okay, hopefully when you ask your advisor, which account should I withdraw from in a given year? Hopefully they don't tell you to talk to your CPA, or they tell you, I don't know, which accounts do you want to withdraw from? They should be giving you advice on which accounts are best. So there's a couple ways to decide. You can just willy-nilly flip a coin. Obviously, that's kind of tongue-in-cheek. Please do not do that. Okay, you can use a rule of thumb. So a rule of thumb that we often see other advisors use is take from your taxable account first. Okay, that's a leaky bucket. You want to empty out that account first. Okay, that is wrong. Okay, never use a rule of thumb when deciding which accounts to pull from. Okay, how you should be deciding is with a forward-looking tax plan. And if it's built well enough, it should be very clear which accounts to withdraw from. And again, not that you need to know each every year, your advisor needs to know, your retirement planner needs to know, okay? Because it can have huge tax implications as we just showed. So again, the reason being is because if we're right on the doorstep of being taxed at 49.95% or 40.7%, we want to know that we do not want to fill in that income with IRA assets. We want to fill in that income with Roth assets. And again, you might even want to fill in with Roth assets over here. Again, it depends on what your situation looks like and what RMDs are going to look like later. You might be here right now in the 12%, 22.2% bracket. RMDs might be significant enough they push you over here. That is bad news. Okay. So let's go through a very simplistic scenario. We're not including Social Security in this scenario. Again, just for simplicity. Let's say we have an example of someone who has $1.5 million total. They have $750,000 in IRAs. They have $750,000 in taxable accounts. Okay. And they need $80,000 a year of income. Okay. So in any given year, there's no Social Security. Which account should they withdraw from? Okay. Well, let's go through a few scenarios. Let's go through the typical advisor's rule of thumb first. Take from that taxable account first. You have $750,000. That's a leaky bucket account, according to most advisors. And so what does it look like if you take from that account first? Just note the reason that it doesn't show up as 1.5 million over here is because we're looking at it in after tax terms. Okay. So notice that them pulling from their taxable account first and then their IRAs second, that they're pretty close to running out of money given this scenario over this 30-year time period. Okay, these last couple of years get fairly scary as they see that 1.5 million dwindle down. Okay, so can we improve on this situation by taking from an account that makes more sense tax-wise? Okay, and the answer is yes. Otherwise, I wouldn't include it in this presentation. So what happens if they took from their IRA first? Now that's counterintuitive to most, but if you've been watching some of these Wealth Wednesdays, it's actually not that counterintuitive because RMDs later will cause them to take more and cause them into tax inefficiency. Okay, so if they take them from their IRAs first, notice that we're a little bit better, $1,000 improvement in their tax value. That's nothing to write home about, but nonetheless, it does improve on the situation through nothing other than tax improvements. Okay. But why be binary? The other accounts. Okay, why not do a split withdrawal? We know that it'll keep our Mute. What about now? Can you guys hear me now? Let me know. I'm thinking, yeah, it should be good. No, okay. Yep. I should be unmuted now. Let me know. Sorry about that, guys. Invariably, we're going to have technical issues. It wouldn't be a Wealth Wednesday if we didn't. So rather than taking all from one account, let's split it between the two accounts. And we see this as a $220,000 improvement in after-tax value. Okay. So is there a fourth door? Is there a better way? Even between two accounts, can we create another door? We've talked about all from one account, all from the other account. We've talked about split withdrawals. Is there another door? And there is. Okay. And this door involves maxing out their bracket in a given year through Roth conversions. Okay, so let's say that they have $15,000 extra before they go jump over into the next bracket. So rather than just allowing that $15,000 gap into the next bracket go unfilled, okay, why don't we fill it in with a Roth conversion? Okay, because we know RMDs later might push us up into an even higher bracket. So let's fill in into a Roth conversion, into a Roth account, so that money is never taxed again and never subject to RMDs again. And so during the first 20 years, it looks like 15 to 20 years of retirement, they're doing a partial Roth conversion. Okay, and after tax wise, everything seems pretty much the same. In fact, this blue line even here is less than the split withdrawal. Okay, we're paying a little bit extra in taxes in order to plan for the future. But notice around that 15 to 20 year range right here, that's where we see the big gap. Okay, and overall, just kind of stepping back, there's a $2 million improvement in this situation. The reason being is because they are completely avoiding RMDs, because they're putting this money into a Roth account that is never subject to RMDs again. And we see the after-tax value of making these decisions early on in retirement. And so filling in your income obviously is filling in your income according to which accounts you should take from, but it's also filling in your income in a standpoint of, we might want to fill in this bracket with additional withdrawals in order to set ourselves up for the future. Do Roth conversions, pay taxes now in order to never be taxed again. Okay. And so obviously there's some, as you can see, there's some huge benefits to doing so. Now, we've gone through all of these 7 steps. The devil is in the details when tax planning. Okay. You need to make sure that your income is exact. You can see just being off by $5,000. What situation that puts that previous couple into? They went from I believe it was something like an 88% probability of success down to a 57. Okay. Make sure you have a forward-looking tax plan, and start to ask your advisor what steps they are taking in order to make my income tax efficient. Okay. If you're not getting legitimate, very clear answers, I would recommend getting a second opinion. As you've seen in this presentation so far, saving on taxes can have a huge benefit, can have a huge implication. Okay, maximizing Social Security can save you thousands of dollars a year on taxes. Okay, taken from the right accounts can extend your retirement savings out significantly. Okay, as we saw with that partial Roth conversion. And so each of these 7 steps is absolutely critical to analyze. Don't just run with one of these ideas, because it can create a tax nightmare. Okay, if you just take one simple idea and maybe your takeaway was, okay, I need to maximize Social Security, and you forget the other steps. Well, those RMDs might put you into a tax nightmare later into retirement, as we showed. Okay, if you're just looking at, okay, which accounts am I going to withdraw from, but you leave Social Security out of that, well, you're going to miss out on that huge tax savings. So each of these 7 steps has to be done and done accurately. So if anybody, obviously, when we do these presentations, we try to give you guys a lot of value and show everything that's out there that you can use to increase the tax efficiency of your retirement income. But we obviously don't go through a incredibly specific example and show you how one specific person can do it. We'd be off. That person's example doesn't apply to you. And so if you want to see how these 7 steps, these 7 ideas can improve your situation, go ahead and comment below. Comment something like tax efficiency below. Okay, if you don't want to comment on a post that everybody can see, go ahead and private message either Tony or I privately and just say, hey, I want a little bit of help on my tax efficiency. I saw that 7 steps presentation. I want to learn more how my income can be tax efficient. And always remember, you don't need more money. You need a better plan. Okay. So just looking at a few questions. Bruce, you asked, what about when Roth conversions push my AGI up too much? So first off, I would ask, what is too much? Okay. Now, oftentimes I see that somebody early in retirement, okay, they might have been taxed at 22% while working. And so when they enter into retirement, maybe they're taxed at 12% because they're not taking as much income. They don't have as much of an income need. And so they're in a lower tax rate. And so they view, okay, if I do a Roth conversion and that Roth conversion pushes me back into the 22% bracket, that's bad, right? Because I'm taxed at 12%. I'll be taxed at 12% next year. I'll be taxed at 12% the following year. So I don't want to pay 22%, even if it keeps me from ever being taxed again, because I'd rather pay 12%. Well, it depends on what your situation looks like going forward in the future. Okay. What happens, Bruce, if you're taxed at 22% right now or 12% right now, but when you turn on Social Security and RMDs start, it pushes you into that Social Security tax trap and you're taxed at 40.7%. Okay. Well, we would pay 12%, 22%, 24%. We would pay any percent underneath 40.7% if it prevented us from being taxed at that rate later. So pushing your AGI up too much is very relative. It's in relative terms. Now, that being said, there are other things that you might want to keep your AGI lower for. Okay, if you're on Obamacare right now, you obviously want to keep that reported income much lower. Okay, if that AGI pushes you up too much and causes, if you're on Medicare and it causes you to be subject to IRMA, okay, well, basically you should add in that extra cost of IRMA into that tax rate. And so IRMA does add an extra cost to healthcare premiums, but it might still even be worth it if you're going to be taxed at a higher rate. So long answer to a short question. Basically, it's in relative terms, Bruce. Okay, what is your AGI going to push you up into? And if it's too much, we have to look at it in terms of what you're going to be taxed at in the future as well. So Anne asked, where do you recommend RMD monies go? So it depends if you are already subject to RMDs or if you're saying money that you're trying to avoid RMDs into the future. So if you're trying to avoid RMDs into the future, a big way to do so is with Roth conversion. So obviously the money would go from an IRA into a Roth. Now, if you're already subject to RMDs and you don't have a need for the money, I'd recommend checking out our charitable giving presentation. There's something you can do called a qualified charitable distribution. If you want to give that money away, it'll basically exclude that money from your taxable income. If you're taking that RMD money and you don't want to give it to charity and you're wondering, okay, where should I put it? I would recommend typically where it goes is into a taxable account. Okay, so that taxable account bucket gets larger and larger if you're taking those RMDs, okay, over time, which means that you need to make sure that you're very buttoned up on that taxable account then, okay? So awesome. Hopefully I answered everyone's questions. Hopefully that was clear. Again, I know I went a little bit long, but some great questions at the end. Again, always remember, guys, you don't need more money, okay? You need a better plan that maximizes the money that you have in your plan by paying less in taxes. And hopefully this presentation helped you in getting to that point. Everyone have a great rest of the day. Thank you for watching. And I got to figure out how to exit out of this. All right. Thanks, everybody. See ya.